All right, welcome back, everyone. Look, if you're tuning in, you're looking for pure signal in a market that is just full of noise right now. Today, we're bringing you a high-stakes, purely data-driven deep dive into Dell Technologies' fiscal year 27 Q1 earnings. We're stripping away all the fluff and getting straight to the alpha. This explainer is going to pit the ultimate bull case right up against the starkest bear realities. So let's just dive right into it. So here's the massive, controversial question we've got to answer right out of the gate. Is Dell's AI boom just a mirage of margin dilution? I mean, this is the exact tension that's literally tearing Wall Street apart right now. On one hand, you've got this explosive historic revenue growth, totally driven by AI. But on the other hand, you're staring down the terrifying prospect of shrinking profit margins as these low-margin AI servers basically take over the entire product mix. By the end of this explainer, you're going to have the specific business insights you need to decide exactly which side of this trade is actually right. Here's the roadmap for today's explainer. We're unpacking the record financials, looking at AI servers and infrastructure, getting into the analyst Q&A showdown, highlighting some hidden risks and bottlenecks, and finally getting to the ultimate investor verdict. Okay, part one, unpacking those record financial metrics. Now, the contrast here is just wild. Seriously, check out these figures. Total revenue hit $43.8 billion. That is an 88% year-over-year jump. Operating income came in at $4.2 billion, up 154%. And diluted EPS, it literally exploded by 214% to $4.86. I mean, that is pure euphoria for investors. But wait, look right there in the middle. Gross margin fell to 18.1%. That's a massive 350 basis point drop year over year. And that margin compression is exactly why the bears are growling right now. They see this massive top-line explosion, but they are terrified that profitability is eroding underneath it all.
But hold on, because management has a serious counterpunch, 8.4%. Operating expenses as a percentage of revenue literally plummeted to a 20-year low of 8.4%. To put that into perspective, total OpEx only grew 9% compared to that massive 88% revenue surge. This brilliantly illustrates Dell's absolute masterclass in operating leverage. You know, they're using AI-driven cost optimization and just really strict discipline to ensure that, hey, even with gross margin dilution, their bottom line cash generation stays absolutely staggering.
Moving right along to part two, AI servers and infrastructure. $51.3 billion. I really want you to just let that standalone number sink in for a second. This represents Dell's massive, record-breaking new backlog. It perfectly emphasizes the sheer, unadulterated scale of institutional demand right now. We aren't just looking at a standard upgrade cycle anymore. This is a fundamental replatforming of enterprise architecture. So how exactly does this demand break down across their tech moat? Well, ISG revenue hit $29 billion, up 181%. And yeah, AI server revenue accounted for $16.1 billion of that, but look at traditional servers right below it, up 92% to $8.5 billion. That totally destroys the myth that AI is somehow cannibalizing traditional hardware. And on the product side, we're seeing the PowerStore Elite offering 3 times the performance with a crazy 6-to-1 data reduction rate, and the PowerEdge 8G delivering an unbelievable 13-to-1 server consolidation rate. It's a real game changer.
Now, you might be wondering, why on earth are traditional servers surging 92% in the middle of an AI boom? Well, it boils down to one crucial strategic insight: agentic AI. See, we're watching AI shift from just being an advisor to an active operator. And that transformation, it creates massive new workloads for harnessing data, handling really intense input/output operations, and managing state. And guess what? Those specific tasks actually require CPUs, not just GPUs. Agentic AI is fundamentally expanding the total addressable market for traditional CPUs. All right, this brings us to part 3, the analyst Q&A showdown.
First up in the hot seat, we've got Ben Reitzes from Melius Research throwing out the ultimate bear case question. He basically asked, is this strong demand just a temporary pull forward? Meaning, is Dell just stealing demand from future quarters and setting everybody up for a massive cliff next year? And Vice Chairman Jeff Clark, he fired right back with the hard data. His defense was that this is a hard refresh. He pointed out that exactly 1/3 of the global PC and server installed base is over 4 years old right now. Guys, that hardware is functionally obsolete. When you add in the impending Windows 11 upgrades and 14G server obsolescence, which you have are structural mandatory upgrades, not some temporary artificial pull forward. Next up, Catherine Campina over at Goldman Sachs zeroed in on the exact nature of the supply constraints holding Dell back. She essentially asked, if demand is off the charts, why isn't revenue even higher? What exactly is bottlenecking the supply chain?
And honestly, management's answer here was pretty sobering. The bottleneck, it isn't manufacturing capacity, it is strictly component supply. They are facing severe structural shortages in DRAM, NAND, and leading-edge CPUs. Dell is quite simply supply capped. They literally cannot source enough memory and advanced processors to fulfill that explosive $51.3 billion order book we talked about, which means a massive chunk of this revenue is just getting pushed into the next fiscal year.
Finally, Tim Long from Barclays went straight for the bottom line. He wanted to know, how exactly is Dell maintaining any sort of pricing discipline when raw material costs are just skyrocketing in this highly inflationary environment? Clark's response revealed a really aggressive, almost brutal strategy. They are executing near-daily repricing across their entire portfolio. On top of that, Dell is defending its ISG margins by leveraging what they call AI fuel. Basically, the extremely high margin attach rates of storage products, like PowerScale, that have to accompany these AI servers. Because unstructured data is the literal fuel for AI, customers are forced to buy the high-margin storage alongside the lower-margin servers. Plus, right now, enterprise clients are prioritizing supply stability above all else. They are totally willing to pay a premium just to get their hands on the hardware. Which leads us to part 4, hidden risks and bottlenecks. 1 full year. I really want you to anchor yourself to that staggering unit of time, because that represents the current lead times for advanced process node components. You heard that right. It takes a full year just to secure the silicon needed to build the systems that clients are screaming for today. And guys, this is the absolute ultimate tension of the quarter right here. On one side, you have management upgrading their full-year revenue guidance to a staggering $165 to $169 billion. That's roughly 50% year-over-year growth. Just incredible. But on the exact opposite side, the persistent structural threat is glaringly obvious. Hyperscaling these low-margin AI servers is going to continue to exert percentage margin dilution pressure on the entire company. So, just to summarize those core bearish risks really quickly, Dell is fighting a serious uphill battle here. They're up against one-year lead times on advanced nodes, persistent gross margin percentage dilution as AI servers totally dominate their product mix, and an inflationary environment that heavily threatens the more price-sensitive consumer and small to medium business sectors. Finally, part 5, the ultimate investor verdict. So here's what I'm leaving you with today. Does a historic $51.3 billion backlog justify a structural margin squeeze? Like, is that top-line dominance enough for you to just ignore a 350 basis point drop in profitability? I want you to drop your stance in the comments below. I really want to see the bulls and bears debate this one out. And while you're down there, tell me, which U.S. stock earnings report should we decode next? Thanks so much for joining me for this explainer, and I'll see you in the next one.